and kick this off. Welcome, everybody, to another installment of Coffee with Carl. Today we have J.P. Morgan joining us, my internal partner here, Brittany. Brittany, thank you so much for coordinating this for us. Why don't you go
Thank
ahead
you.
and introduce your wonderful partner and speaker for today.
Thank you so much, Carl. And as Carl mentioned, my name is Brittany Galato, and I'm an internal client advisor at J.P. Morgan. So I partner with Carl Grund and his team, and today I'm honored to introduce my colleague, Josh Feuerman, who'll be presenting a market and economic outlook. Josh is a global equity strategist, managing director, and holds a CFA. Josh joined J.P. Morgan in 2012 from Foundation Capital Partners, where he served as Chief Risk Officer. Previously, Josh ran his own investment firm, where he managed a quantitative market neutral hedge fund. And prior to founding BTN Partners, he was a vice chairman of the investment committee and head of global quantitative equities at Deutsche Asset Management. He was also the head of active international equities at State Street Global Advisors. He has a lot of experience, holds an AB in economics and Romance languages from Bowdoin College, and has an MBA in finance from the University of Chicago. So thank you so much, Josh, for joining us today. Happy to hear what your thoughts are on the market and the economy.
Great. Thanks, Brittany. And thanks, everyone, for joining. One thing Brittany didn't tell you about my background, I grew up in Brooklyn, New York. And back in Brooklyn, we used to say nobody knows nothing about nothing, right? That's true about life. It's true about the markets, right? Nobody knows what's really going to happen with the markets. Nobody really knows what's going to happen with the economy, right? So, what we're going to talk about with our time together is based upon, I've been doing this for 35 years, so some experience and some market history as well. What I've found when I do these types of calls is it's sometimes easier to make sure we're all speaking the same language first before we talk about what's happening with the market and the economy. So the first thing I always like to talk about, and I just use the word the economy, right? So some of you maybe remember James Carville, right? He was part of the Clinton campaign. And part of what he came up with this expression was, it's the economy's stupid, right? And basically, if the economy is good, the sitting president tends to win. And if the economy is bad, you get a change in the White House. But people's definition of the economy will vary, right? So if I ask the people on this phone call, how's the economy doing? Most of you would say, no, it's doing pretty well, right? Which is that your stock market portfolio is still up a lot, given even with the sell-off this year. You own a home, maybe you own two homes as well. And, if you're employed, those are all good things. So for most of us, the economy is doing well. But the median income in the United States is $65,000 a year, right? So if you think about it, that's pretty much half of all the people. So if you're at $65,000, you don't own your home probably. You probably don't have an investment portfolio, right? And you're living paycheck to paycheck. So for those people, the economy is not doing that well, right? And those are the people who showed up in November for a change in the White House. Now, the government measures the economy differently. And I'm going to try to share my screen here for a second, and we'll see if this will work. And the government looks at something. Let's see if we get this to work. Now, there we go. The government looks at something that they call gross domestic product. It stands for GDP is the acronym. And the way they measure it is they measure all of the spending that we do. And that's that big blue bar called consumption. They also look at all the spending the federal government does. Right? And they add in state spending as well. Those are the two green bars. And then they look at all the spending that businesses do. That's the gray bar. But just look at this picture. Basically, 70% of our economy is spending by individuals. It's spending on goods and it's spending on services as well. We are a nation of spenders, right? So as long as we are spending, the economy grows, right? And that's called, positive GDP growth. And if we stop spending, the economy stops growing, and that's called a recession. right? So basically every quarter they do this calculation, and if the quarter over quarter number increases, that's the economy growing. And if it decreases, that's the economy contracting as well. Now, I'd like you to think about the US economy as the world's largest super tanker. And we're going to call our super tanker USS GDP. And our super tanker has two captains, neither of which has a steering wheel, but they both have a throttle to make our boat go more quickly. And one of our captains is the federal government, Congress and the White House. And if you think about it, the federal government really wants the boat to go as quickly as possible, because if the economy is growing, they get reelected. So the federal government really has no incentive to ever pull back on the throttle. However, the problem is if the economy, our boat is going too quickly, and remember what drives the economy is spending, right? So if we're spending a lot, price levels are going up. And now we got to talk about a weird concept called inflation. Now, we hear all the time about inflation, and inflation is a weird economic concept because a lot of people think high inflation equals high price levels. So if inflation is falling, price levels are falling. And that's actually not true, because inflation is a weird economic concept that measures the rate of change in price levels. The rate of change, what the heck does that mean? So let's say you go into the supermarket and the loaf of bread is $1. And then you come back a week later and the loaf of bread is not $1, it's $2. So the price of the loaf of the bread went up by $1 and went from $1 to $2. But the rate of change was 100% when we went from $1 to $2. Now we come back a week later and the loaf of bread isn't $2, it's now $3. Right? So the price of the bread went up by the exact same amount it did last week. It went up by $1, but the rate of change when we went from $2 to $3 was 50%. Now we come back a week later and the bread's not $3, it's $4. Once again, the bread is going up by $1, but now the rate of change was 33%. So the amount, the price level change keeps going up by $1, but the rate of change fell from 100% all the way down to 33%. So when you hear that inflation is falling, that's a good thing, but it's nothing to get really excited about because it still means price levels are going up dramatically. Right? So falling inflation is this weird economic term called disinflation. It means price levels are going up, but the rate of change is still falling. Right? And right now, inflation is around 3% or so. Now, for the people on this phone call, inflation is a nuisance, right? Because you go into Carl's office and you say, do you know how much it cost me to fill up the Infinity today with gas? And did you see how expensive the organic salmon is at Whole Foods? But you know what? You're still filling up the Infinity and you're still buying the organic salmon, right? For us, we are fortunate because inflation is a nuisance. Right? But think about those people at $65,000 or less. They are living paycheck to paycheck, and inflation means they are just not keeping up. If we look at the lower income levels, given how strong inflation was coming out of COVID, the lower income levels are actually worse off than they were before COVID because price levels have gone up so much. Now, remember, I said on the US GDP, we have two captains, and we've only talked about one captain so far. The other captain is something called the Federal Reserve Bank of the United States. It's called the Fed. And the head of the Fed is Jerome Powell. And the Fed's job, they want the US GDP our boat to keep going forward, but they don't want it to keep going forward so quickly that inflation is going up too quickly, which is really hurting lower income levels. So the Fed's job is to protect people who are suffering from inflation. Now, the Fed's got a very bad tool for fighting inflation. It's something called the federal funds rate, and that's what we show you on this picture. Just think about the federal funds rate as the interest rate that banks earn on money that they keep at the Fed. Now, why do banks keep money at the Fed? It's the law. So for every dollar that we put into a checking account or a savings account, the banks have to keep a small percentage of that amount at the Fed. And the reason why that happens is it prevents runs on the banks. Because if you remember the movie It's a Wonderful Life, remember George Bailey, it was a trust, it was a bank basically, and he took all of the deposits and he loaned them out for people to buy mortgages, right, or buy houses using mortgages. And the problem is, if the bank lends out all the money we have in them and people show up to take their money out, they have no money to do that. It's called a run on the bank, and the bank goes insolvent. Right? So post the Great Depression, the government said, well, if you're a bank, you have to keep a certain amount at the Fed to try to make sure the banks don't go insolvent. So what the Fed does is say, look, you have to keep a certain percentage of every dollar here at the Fed, but you could actually keep more if you so choose. And federal funds rates, more or less, is the interest rate that banks earn on the money they keep at the Fed. So the Fed could raise or lower that rate depending upon what they want both the USS GDP to do. Right. So think about this at a very extreme level. If banks could earn 10% by keeping money at the Fed, if they're going to make a mortgage, they're going to do it at 12, 13, 14%. If they're going to issue a credit card, it's going to be at 20%. So when the Fed increases Fed funds rates, it tends to slow economic activity. It slows our boat down. Right. So people aren't buying houses and they aren't buying stuff at Home Depot, and your credit card debt is more expensive and your auto loans are more expensive. And all of that slows up economic activity. And however, if the boat is going too slowly and inflation is at an acceptable level, the Fed could cut Fed funds rates, and therefore you get more economic activity. The problem is it takes about a year from the time the Fed changes interest rates till it affects our spending habits, right? So the Fed, right, had been raising interest rates because inflation was too high, right? But sometimes they raise Fed funds rates too high and our boat goes backwards. The economy contracts, and that's a recession. Right now, you could see on this picture, the Fed funds rates are around 4% or so. But if you looked at the economy, inflation is around 3%, and that's kind of an acceptable level for the Fed, right? So the Fed yesterday met and decided we're not doing anything with interest rates here because inflation is at an acceptable level and the boat is still going forward at an acceptable pace. Now, so we talked about how we measure the economy. We talked about the USS GDP, and we talked about the federal government on one side and the Fed on the other. Now, I do not talk politics, but we're going to talk policies, because what you've seen a lot in the news are tariffs. Now, tariffs I always say there are three types of tariffs out there. Now, tariffs, you can think about this. Tariffs are a fee that is applied to goods as soon as they touch down on a country's soil. Right? So right now, there are basically three types of tariffs that we're dealing with. I call them the 3 R's of tariffs. We have reciprocal tariffs, we have restrictive tariffs, and we have revenue tariffs as well. And let's flush out those three. Reciprocal tariffs are kind of thought what we were going to get back in January, because that's what the president had been talking about for a while. And reciprocal tariffs are just used to balance out the different tariff rates amongst different countries. So, for example, we import 600,000 European cars a year into the United States. We export 100,000 cars to Europe. Now, if you looked at the tariff that's applied to European cars coming to the United States, that means you pay them when you buy an Audi or a BMW. It's about 2.5% of the value of the car. And that's built into the price of the car that you pay. American cars going to Europe are hit with a 10% tariff. Well, that's not fair, right? And we should level the playing field. Get the tariff rates to be the same. Now, just because if Europe lowers the tariffs on American cars, I'm not sure we're going to be exporting a whole bunch more American cars to Europe, because if you've been to Europe, the roads are very narrow. There's not a lot of parking, and gas is unbelievably expensive. So just because you level out the tariffs does not mean all of a sudden you're going to see these Ford F-150 pickup trucks circling Piccadilly Circus. But that was the idea behind reciprocal tariffs. And that's a negotiation process, and that's what we thought we were getting. But then we brought 2 more R's into the mix, which are restrictive tariffs and revenue tariffs. Restrictive tariffs are very traditional forms of tariffs, and you use them, as the name implies, to restrict access to your market from inexpensive imports, because they would wipe out your domestic manufacturing. So about 1.5 years ago, China was sending these very inexpensive electric cars to the United States called NIOs. And they were like $30,000. And if we allowed them to flood our market with these $30,000 electric cars, it would have destroyed the EV market for domestic car companies. So we said, we're not going to allow you to do that. And we put 100% tariff on the cars. Right? And then China started dumping them into Europe, and Europe said, no, not in my backyard. And they slapped 100% tariff on it as well. Now, if the goal of the tariffs are to bring jobs back to the United States, I'm not sure we're going to get that done. I'm not sure these tariffs are going to accomplish that. And the reason why I say that, if you're a domestic company, right, and you're going to build a factory here in the United States, it takes billions of dollars and years to build that factory. The problem is these tariffs that we're setting up, if they're restrictive tariffs, could end with a single tweet, or they might end in January of 2029 when a new president takes over. Now, I know January of 2029 seems very far off, but if you're building a factory, it's not that far off as well. So realistically, if the goal is to bring the tariffs back to to bring jobs back to the United States, we need Congress to pass the tariffs, because then it becomes a law. So restrictive tariffs are the second R. And the third R are what we call revenue tariffs. Once again, very traditional. Prior to 1913, we did not have an income tax in the United States. So 100% of the federal government's revenue came from tariffs on goods we imported. Then we still started collecting income tax, and you can see that the tariffs came down as well. If you look at this picture, you can see that kind of, this is almost 100 years worth of data, right? And you can see that they did jump up again during the Great Depression, but then came back down again as well. So if the goal here is to generate revenue For the federal government to cut taxes or pay down the debt, they have to be there for years and years and years. Right now, we do not know which of the three R's we're trying to accomplish. And we also don't know who's going to pay the tariffs, right? So the concept is, let's say something right now is $100 and you're going to hit it with a 25% tariff. So the second that good is unloaded at a U.S. port, U.S. customs officials collect a 25% tariff. So if the value of the good is $100, they collect a $25 tariff, and that good is now, the cost of that is now $125. The Pete Navarro is the tariff czar, as they've been calling him. You know, it's his thesis that the Chinese producers, where we import a lot of stuff from, would pay for the tariffs themselves. Here's the way the math would work. Remember, the good is currently $100. So the Chinese producers would have to cut their price to $80. So now the second it hits a U.S. soil, it gets hit with a 25% tariff, but 25% of $80 is $20. So the cost to us is still $100, but the Chinese producer, rather than selling it for $100, sold it for $80. So they make less money. The problem is we're in a trade war with China, and I'm not sure the Chinese government is going to allow their producers to absorb the tariff. They want us to feel the pain, right? And so that means we have to pay the tariffs here in the United States. And we do not know now if companies are going to pay the tariff or if we have individuals are going to pay the tariff. And it's going to vary by company and by industry as well. So I'll give you one quick example. Just this morning, Ford Motors announced that for 3 of their cars, they're raising prices due to the tariffs. If cars become more expensive, people are going to drive their cars longer, which means they're going to break down more. And almost all the auto parts that we get here in the United States are imported. Now, when your car breaks down, when you need the part, and you can't haggle on the price. So companies like AutoZone or O'Reilly, they may be okay because even though they paid the tariff, they're going to be able to pass 100% of the tariff on to us. But if you're a Dollar Tree or a Dollar General or a Macy's or a Nordstrom's or a Kohl's, right, you probably will not be able to pass the tariff on to their customers. Right? And that means their earnings are going to take a hit as well. Now, in terms of what's happened in the stock market hates uncertainty. The stock market can deal with tariffs. They just can't have the rules of the road changing every month and over time, right? And so what you've seen, what this shows you, this is 45 years of stock market performance. That's the bars that we show you here. And 34 out of 45 years, the stock market ends up positively. It's not all the time, but it's a lot of the time. The red dots that you see is the largest drop the market experiences in any calendar year. Now, you'll notice there's always a red dot. And now, if you look at the subtitle in the upper left-hand corner, you can see the average drop is around 14%. Now, we were down from the highest point to the lowest point this year around 19%. You can see that all the way over here. But look at the years to the left. Last year, we had an 8% drop. The year before that, a 10%. It's been a while since we've had a normal drop in the market. And this is kind of in the ballpark as well. Now, I'm not saying 19 is as bad as it gets, right? Because we still don't know which of the 3 R's we're trying to accomplish, right? Reciprocal, restrictive, or revenue. And we still do not know who's actually going to be paying the tariffs as well. But because if you look at those bars, 75% of the time, the market ends up positively. I'm not saying that's necessarily going to be the case this year, but that's why we tell people market timing does not work. No one could time when to get in and out of the market. That is a losing game. So what we always tell to investors is market timing is a losing game. What this is about is time in the market. Right? And that's why you are long-term investors. That's why Carl's got you in a diversified portfolio. All of your assets are not 100% in the S&P 500 or US equities. You hold lots of different investments, right? And volatility is normal. Right? It may be a couple of months until we get clarity on which are the three R's. It may be a couple of months until we understand who's actually paying the tariffs. But this too shall pass. So the one thing I'll leave you with, and I'll stop sharing my screen here. I think this administration has made it very clear that they are focused on the midterm elections. And what I mean by that is they pulled the UN ambassadorship nomination from the Congresswoman from New York because she's a Republican and they weren't convinced that they were going to be able to hold on to their seat. So this administration is very focused on the midterms. So whatever omelet they're trying to cook with the tariffs, whatever eggs they need to break in order to make that omelet, they're pretty much going to break it between now and the end of the year or early next year. Because going into the midterm elections in November of 2026, they need probably 6 months of good economic news and 6 months of good stock market performance. They cannot rectify this situation in September of 2026. It's too late at that point, right? So if they don't start to make moves by the end of this year or early next year, my guess is you'll start to see a Republican revolt in Congress as well. But volatility is normal. This too shall pass. And ultimately, this may end up being a buying opportunity as well. Maybe not yet, but over the next couple of months. So, Carl, with that, let me pause. I'm going to take a sip of water. I know we've got some time. Let me see if we have any questions.
Yeah, I got a few. When you guys are managing portfolios, obviously you're having a long-term tilt. How do you guys deal with this influx of news? Have you guys done any shifts to just strategy, with respects to the tariffs and the uncertainty? Because I know
Yeah,
people come out there and talk now, like Paul Tudor Jones yesterday is calling for pretty big drops in the market. Have you guys changed any thesis points as well?
Yeah, first, we are always fully invested, right? Our job is not to time the market. We can't do it either. So when Carl entrusts us with your assets, our job is to put your money to work. But we do realize during periods of uncertainty, right? Because we don't know, once again, I'm going to go back to that comment on the tariffs. We don't know if companies are going to take a hit to their profit margins or if they're going to try to pass it on to us as well. So what we tend to do is reduce the risks in the portfolio. We try to move to names that we think are more secure, and we try to diversify our bets as much as possible. What we're trying to do is to protect your client's assets. But remember, we can't determine if the market's going up or down, right? So if we think the market's going to go down, we try to reduce the risk as much. But once again, we don't know if the market's going to go down. So in the event the market might go down, we reduce risk. We try to protect your client's capital, right? And then when we get a little bit more clarity, we take on more risk as well. I will tell you that we have been picking stocks in the United States for almost 40 years. Right. So we've seen a lot of different environments. And what we have found historically is that there are going to be points in time when it's difficult to pick winners and losers. So we will reduce risk as much as possible. And then when we get better clarity, we dial up the risk. What we have found over our 40-year history is that whenever times have been difficult, when times have gotten better, we have historically always made back what we've lost and then some as well, right? So that's the advantage of working with a time-tested process and a time-tested manager, because over the last 40 years, we've seen a lot of different things as well, right? And we're able to learn from experience.
Do you guys, from an opportunistic standpoint, you're starting to hear some folks now actually looking to international. Obviously, international struggled from a return perspective over the last, call it 10 plus years. Do you see there is more opportunity there now with, some Germany and some of their spending, or just or would you like more US? How would you compare the two when it comes to the investment?
Yeah, all the thing people talk about is U.S. exceptionalism all the time, right? Now, to me, U.S. exceptionalism means two things. It means we have the best companies and the best economy as well. We still have the best companies out there, right? I think technology, well, we know for a fact technology was what drove us this forward. Technology is the wave of the future, right? It's not as though the world has changed, and the best tech companies in the world come from the United States, right? That has not changed from this. So in terms of U.S. exceptionalism, from a company perspective, nothing has changed. Now, what has changed is on the economy side. And unfortunately, we have demonstrated we are not a trustworthy trade partner, right? Because when you cut a deal with someone, the assumption is the deal's going to stick. You can't just say, oh, yeah, we had a deal, but I changed my mind and now I want to renegotiate, right? Because even if we back off and say, oh, our bad, let's put all the tariffs back, we've demonstrated we're untrustworthy, right? And what that's going to do is force people who are formerly our friends to unfortunately deal with people who are currently our enemies, right? So China is cutting deals with Europe now, right? So where we have damaged U.S. exceptionalism is from our reputation. So yeah, Warren Buffett's been in the news a lot because he just announced he retired. For those of you old enough to remember, back in the 80s, Warren Buffett for a very short period of time was the CEO of Salomon Brothers, because Salomon Brothers really screwed things up back in the 80s. And Warren Buffett famously said, it takes a lifetime to build a reputation and 5 minutes to lose it. And so the question is, and I don't know the answer to this, in January of 2029, do our former friends say the U.S. is not trustworthy, or do we say it was, really this current administration and the next administration, and it depends on who the next administration is someone we could trust? That's where we've demonstrated, that's where we've hurt U.S. exceptionalism. And I will say to your clients, Carl, and I say this whenever I'm asked this question, you tell me why French stocks are going to beat U.S. stocks for the next decade. They're not, right? The best hope for the French stock market is when AI comes to fruition, and it's going to take 5 years for that to happen at least, all of these new AI billionaires turn around and buy a boatload of Louis Vuitton luggage. That's the best hope for the French stock market. But there has been no structural change in terms of the stock market themselves. Now, it may be that historically, the U.S. whooped international for a decade because we had all of these tech companies growing at tremendous rates. It may be that what the companies we call the Magnificent Seven may not be the leaders in the next round going forward. So it may be that the U.S. outperforms internationally, maybe it might not be this year. This may be the year for internationally, but it may take a couple of years for the U.S. to reclaim its company exceptionalism, because we got to figure out who the true winners of artificial intelligence are. And we don't know who that is yet as well.
What about, I guess along the same lines, what about Asia? China's struggled from an investment perspective over the last couple of years. Do you see an opportunity? And almost some people say it's uninvestable, but if we're thinking AI could be a leader, and obviously they have tech companies and starting to become pretty exceptional in that space, do you guys like them from a maybe country-based investment process?
Yeah, we don't. I agree with you, though. I think the true winners of AI will be companies based in China, India, and the United States. The problem is, China isn't trustworthy either, right? They don't have a free floating currency, right? And it's not a capitalist society. There was a very famous guy by the name of Jack Ma who started this Ant Group, but he did Tencent, all these other major Alibaba, sorry, that's what I was thinking of. All these major Chinese companies, he got on the wrong side of the Chinese government and they sent him to a re-education camp. He disappeared for about a year or so. He's recently come back again because he had been re-educated. But I'm not sure that's the type of country I want to trust with my money as well. But to be honest, China is probably going to be might be the world's largest economy by the end of this decade. not on a per capita basis, right? Because they have so many more people than we do, most to be the largest, but in aggregate. But we don't really like China here because they're not trustworthy either. India is an interesting investment opportunity, but India looks kind of expensive as well. But longer term, if I'm going to invest outside of the my borders, I think your opportunity sets are better in India than China.
Yeah, I mean, it seems that way. I mean, with the population opportunity they have compared to arguably China and obviously what we're having here in the US.
Yeah, India has grown through the export of intellectual capabilities. All other countries grew through the export of cheap labor. And what I mean by that is JP Morgan has a huge presence in India, both Mumbai and Bangalore, where we hire these kids out of the India Institute of Technology. It's the MIT equivalent with MBAs, and we pay them like $60,000 a year. And that makes them upper middle class in India. I'll tell you, we're hiring kids out of college at JP Morgan from US colleges at like $120,000 a year. Right. So from a JP Morgan perspective, I'd rather have a kid with an MBA from the IIT than a snot-nosed kid coming out of college for half the price. Right. So that's the true opportunity set. And there's no one, obviously, who, remember, Japan grew through the export of cheap labor coming out of World War II. China grew through the export of cheap labor through the 70s and 80s. Vietnam, Malaysia, Bangladesh, they're all growing through the export of cheap labor now. It's hard to see who's going to displace India through the export of intellectual capabilities.
Very good point. And then as folks, if anyone wants to send in a question here as we finish up today, please feel free. As we're rounding up, I guess one of the questions I have too, just when we're looking at U.S. markets, an area of struggle, when talking about diversified portfolios has been called like the small cap space.
Yeah.
Do you guys see opportunity emerging to invest there? I know a lot of these companies still continue to struggle.
Yeah.
And how would you guys think about that just from a portfolio allocation standpoint?
Yeah, so I'll tell you, Carl, personally, I went overweight in September, small caps. So I've been telling people I wasn't wrong. I was just early, which is another way to say you're wrong. I mean, if you think about it, small caps tend to borrow in shorter time frames, like 6 months. Coca-Cola and Apple borrow 30 years long. Right. And small caps need to borrow a lot more money to float their operation than large caps do. So remember the Fed, we talked about them before. They've been cutting interest rates starting in September. They had been, which historically tends to be good for small cap stocks. So that's the first thing. The second, small caps, because they're small, they can't really negotiate the price they pay for wages and inputs. And because they're small, they can't really push on inflation to their customers. So inflation had been falling dramatically in the fall. That tends to be a good environment for small caps as well. And then the forecast was, and this is what's changed, that small caps were going to have greater earnings growth than the large cap stocks, both this year and next year as well. So for all of those reasons, that's why I went overweight small caps in September. Now they got whooped upside the head due to tariffs, because small caps import a lot of goods, right? And because they're small, they can't pass on the tariffs. So tariffs hurt small caps, and small caps are domestically focused. And there is concern with these tariffs that the U.S. GDP, remember our big boat, may start going backwards, and that's called a recession. And in a recession, small cap companies suffer as well. So I've been telling advisors, maybe don't follow my lead yet and add small caps, but there is a tremendous opportunity there in small caps. It just may take a couple more months to flush out what the impact of the tariffs are and whether or not. Remember, remember 2/3 of our economy is consumption. Remember that big blue bar. If companies pass the tariffs on to us, think about the people who make $65,000 a year or less, right? They're going to be buying less stuff because they're going to be paying the tariffs to the U.S. government. If they're buying less stuff than they were in 2024, that causes consumption to shrink, and that causes U.S. GDP, our boat, to go backwards, and that will cause a recession. and that will hurt small cap stocks. We'll have a better idea, sort of the back half of this year, what the economic impact is of the tariffs as well on the economy.
So when you mentioned, as we bring things full circle, you mentioned obviously recession, a number of times. And I think one of the challenges people hear on TV, recession, 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 you know, what does that really mean when it comes to portfolios? Because if the economy is slowing, if it maybe slows a little bit, but the Fed's cutting, stock market can go up. So how should an investor who's just hearing all this news, really read into it? Obviously, we're cautioning them to invest for the long term. But how do you kind of take some of the media cycle when they turn on the television, when they're, hearing concerns there, and then took that into the market?
So first, Truman famously said a recession is when your neighbor loses his job, and a depression is when you lose your job, right? From a stock market perspective, the only reason why we care about the economy is the impact to corporate earnings, which is if the economy is growing, earnings tend to go up and the stock market goes up. If our US GDP boat is going backwards, that's a recession. Corporate earnings tend to contract and the stock market sells off. Now, the stock market is forward looking. Right now, we had a very big sell-off, 19%, if you remember that red dot, because people were very concerned about the impact to corporate profits for the tariffs and the recession. Nothing's changed, right? Now, if we had stayed where the tariffs were on Liberation Day, things would have been really, really bad. But remember, we still have 10% tariffs across the board in place, and that's higher than tariffs have been for the last 100 years. So I think the stock market, to be honest, is wrong with this rally that it's seen, because the stock market thinks we're out of the woods and we're not yet.
So
as well. So yeah, and then Carl, let me just add one thing, because I want to share with your clients the best piece of investment advice I could give them. And I hope they have a pencil handy. Here's the best piece of investment advice, and I've been doing this for 35 years. Turn off CNBC. CNBC is financial pornography. You watch it, you feel guilty. It's bad for your relationship with Carl. Because remember, CNBC is paid to instill you with fear. Because if you are fearful, you will watch and they will get revenue dollars from their ads. Right? If they come out and say everything's hunky-dory, I will tell you Guy Fieri and Diners, Drive-Ins, and Dives is much more relevant to my life on the Food Network than CNBC. Right? You pay a financial advisor to worry about the market and economy for you. That's Carl's job. Right? And if something major is happening, it's his responsibility to make you aware of it and make the appropriate moves in your portfolio. So stick to the Food Network, turn off CNBC.
Appreciate the plug. And yeah, that's why we're here, guys. I mean, we want to be a resource for you as we deal with this volatility. Josh, one last question. I know we've talked about the economy, we've talked about the market. Is there anything that we're not thinking about right now that maybe concerns you, not necessarily today, but down the line? That could affect the market more in the longer term frame?
Yeah. So the thing that concerns me the most is the size of our federal debt. And the reason why I say that is if you remember the US's GDP, we talked about that. Our GDP is something like $21 trillion. Right? The amount of money our government owes is close to $30 trillion as well. Our debt, I'm sorry, that's wrong. It's probably close to about 24, 25 trillion. Our debt is 120% the size of our economy. The last time we had debt relative to GDP of that level was World War I, World War II, the Korean War, and COVID. In all four of those instances, we were issuing debt to stimulate the economic activity and to pay for war, right? Right now, we're just issuing debt to pay off the interest on previously issued debt. That would be the equivalent of one of you walking into Carl and say, hey, Carl, I got a $50,000 Visa balance. So what I'm going to do is I'm going to take a $50,000 cash advance on my Amex card to pay off my Visa bill. I'm hoping if you did that, Carl would whoop you upside the head and say, no, you're not. We're going to rein in your spending so you pay off your Visa bill. But you're going to go through a period of pain, right, where you're not spending to pay down your debt. Unfortunately, we need to whoop Congress upside the head and tell them to stop spending, but it's not going to work because remember, they have no incentive to pull back on the throttle. The more they spend, the more likely it is they get reelected. But ultimately, you got to pay the piper, right? And so ultimately, in my view, that means taxes have to go up at some point in time, right? Now, if corporate taxes go up, corporations will always figure out a way to make money. But if tax rates are higher, they're going to make less money, which means earnings will grow less slowly. And remember, I told you the stock market follows earnings. That means stock market returns may be lower for an extended period of time. If they increase taxes on us, we are a nation of spenders. But if we're spending less, that means the GDP grows more slowly as well. So I'm very concerned that we have borrowed future stock market returns and future economic growth. I just haven't figured out if we borrowed it from my kids or my grandkids. And I don't have grandkids yet as well. But somebody's got to pay for this eventually. And now, I don't want to be too depressing, but every major every empire historically has run out of money, right? And that's caused them to fall apart as well. Up in the Roman Empire, right? The Byzantine Empire as well. And unfortunately, we're following in those footsteps. Maybe the best we could hope for is we'll all be dead before the empire falls apart, but that's not really a happy way to end this conversation.
Yeah, not ending on a happy note. I mean, that's been the sentiment you've heard from.
Well, here, let me do it on a happy note because I know, and then we'll let people go. AI, artificial intelligence, is going to be transformative to our lives. We are just in the hype phase of artificial intelligence. We have achieved no efficiency gains yet. But I do want to tell people, and this is why it is important to use forward-thinking active stock pickers, because the true winners of artificial intelligence will be companies that haven't even been invented yet. For those of you old enough to remember when Al Gore invented the internet, there was no Amazon, there was no Meta, there was no Google, right? Those were all second and third generation names. It is naive of us to think that those trees, Amazon, Meta, Google, are going to grow to the sky, because trees never grow to the sky as well. You may have heard about this company called NVIDIA. NVIDIA wasn't even in the top 5 of the index 5 years ago. So 5 and 10 years from now, we are going to see different names at the top of our stock market. I believe it will be technology names, but nothing says it has to be Apple or Google from here. Right. So forward thinking, I think AI will be transformative. And hopefully, Carl has you involved in some of our products that are forward looking to invest in some of those winners on a go forward basis. So there, I ended on a happy note, Carl.
Yeah, I mean, and that's why we partner with firms like J.P. Morgan. You guys are able to access their research. They're certainly a leader in the space when finding, the best names to go out there and purchase. So with that, thanks everyone for joining, myself and Ben Williams from my team, and Brittany and Josh from J.P. Morgan. It's always a pleasure, and hope everyone has a wonderful day. And thanks again, Josh and Brittany.
Thank you. Take care.
See you guys.